Anyway, why the implied volatility is important? The implied volatility, once again, is the volatility that you calculate using the Black-Scholes. Is everybody happy with that?
Do they still price options using this model?
Pardon me?
Do they still price options with this model?
Yeah. Not all of the, yeah, but they do. In some of them, but there are some other stochastic calculus models which are extremely complicated, and they use them to price option. Stochastic obviously means random, so for instance the binomial tree or the trinomial tree or Monte Carlo simulation. There are other more complicated stochastic calculus model that you can use.
So they all come from this foundation?
Yeah, the problem is, I tell you why, this model is very popular because it's quite easy and it's quite quick. As I told you, if you go on that website I showed you and you just plug the number in, and it works like a calculator. You have the price in 2 minutes. So even though you are a technical trader, you don't know anything about econometrics, all this boring mathematics stuff, you don't need to know, okay? You just go there, you plug the number in, and you get the calculation. It's very easy to do. If you want to use the Markowitz calculus for option prices, the formula is this big and it's going to take you at least 10 minutes to calculate that. If you don't know stochastic calculus, oh well, if you know stochastic calculus, it takes 10 minutes. I've done it, it took me 20 minutes to calculate the price of one option. And when I've done it, obviously the price was like 20 times lower than the value I calculated. So those models are extremely time consuming, and you cannot use those models unless you've got a software which does that for you. But those software costs quite a lot of money, but it's still good because you can use this software to calculate, to price an option and to calculate implied volatility without spending money. That's why they're still used. Okay? So implied volatility, once again, which is the volatility specifically calculated using this model, follows a stochastic process. What a stochastic process is? Come on, guys, we went through this. Kind of. What is stochastic volatility? We went through this in slide 4. Stochastic volatility is the tendency of volatility to revert.
The beat.
Exactly. Okay, it works, once again, guys, like an oscillator. Overbought and oversold. If it's oversold, it means the price is too cheap, is too low. It means nobody is willing to sell at that price. So it will have to go back, it will have to jump out. And exactly the same when it's overbought. It works exactly the same way for a stochastic process. When the volatility is too high, it tends to reverse to what it's mean. When it's too low, it does exactly the same from the way around. It works exactly like an oscillator, like the MACD, like the relative strength index. It's very easy, guys. It's very easy, and I'll show you how. Implied volatility, which can be asymmetric, by the way. Asymmetric means, once again, that when there is a negative shock hitting the market, what volatility do? What usually volatility does? Increase or decrease? Increase, exactly. Okay? Can be asymmetric, can be traded using the market profile approach. What the market profile is? The market profile, it's not my idea, unfortunately. It was developed by Peter Stadelmeyer, which I think it's not even English, probably is something like Swedish or I don't know, in 1996, and it is a registered trademark of the Chicago Board of Trade. So if there is anybody working for the Chicago Board of Trade, please, I mentioned that. Originally introduced for commodity futures prices, like for almost everything, it is essentially a statistical approach to the analysis of price data. It's really, really easy. That's why, once again, guys, if you are a graduate and you want to get started with trading, you want to take notes of this. You want to take notes now, and you want to understand how this works, because you don't need money, a lot of money, to trade this strategy. You don't need a powerful software to trade this strategy. You don't need extremely complicated programs to trade this strategy. The market profile format organizes prices and time into visual representation of what happens over the course of a single session. Single session, 1 day, 1 month, 1 week, whatever you're trading. It displays what? Price distributions over a fixed period of time. That's all it is. It's just the price distribution over a fixed period of time. In a market profile is useful in order to detect three areas: fair value area, an unfairly low area, and unfair high area. Now I'm going to explain you how and what these areas are and how we can use those areas in order to trade. Just bear in mind, fair value, unfair high, unfair low. Unfair highs and lows are determined by investors and position traders, whilst day trader trade in fair value area. I'll give you an example very soon. Remember this: buy signals unfair low, sell signal unfair high. It works like an oscillator. Is everybody happy with that? Okay, it's very easy. It's very easy. The market profile determines price levels, whilst asymmetric volatility tells you which level you should be looking at. It tells me that's what happened in the crude oil futures market. Okay, the price started about, this is the time frame, 2007, 2010. Those are prices: $60, $140, and then go back to 80. What the market profile is this. It's just purely and simply the distribution of the area of the price. Now I would like to see if you understood what the fair value area is for you.
7.
Excuse me?
70.
It's around here. So the strategy is quite, in a second you will realize, usually this strategy works quite well intraday. How many of you trade intraday? Okay. Let's assume you're an intraday trader, okay? If you are an intraday trader, you stick here. It means that all the time prices have always, every single day, there's no way to escape, there's no way to avoid, have got an intraday average. Okay, the day trader looks at the fair value area, okay, because you don't want to buy here, because what? This is an unfair high. So if it's an unfair high for the stochastic volatility process, here the volatility is going to be very high or very low, or very low. Very low. If it's an asymmetric market, it's going to be high or low. It's going to be high. So what's going to happen to volatility and price? Is they're going to go back to the value, to the fair value. Okay? If it's here, this is too low. Okay? If I'm a day trader, I know that the average value is this one. It's 75. It's 73. So what if I'm a day trader? What should I do here? What would you do? Would you go long or would you go short here? You go long. You go long. So the problem is, if everybody is a day trader, how come we've got lows and highs?
Position traders.
Exactly. Position traders and investors. Okay, I'm a position trader, I'm an investor, and my time horizon is much larger, it's much bigger. Okay, I don't see in 1 day, I see things in 2 weeks, 3 weeks, 2 months, 3 months. It means what? If my forecast is that the price is gonna touch 120, and I'm here, the price is 100. If I'm a day trader, would you buy at this level if I'm a day trader? No, you don't buy. You go short here because according to the symmetric volatility process and stochastic volatility, guys, stochastic volatility is a type of asymmetric volatility, so don't get confused. If it's here, the price is gonna go back to this level. So I would go short in this. But if I'm an investor and I think that the price is gonna go to 140, I buy here anyway.